Today's guest was named one of the greatest financial historians of all time by Fortune magazine. He's an expert in financial bubbles, and his new book, The Price of Time, examines interest rates and central banking. This is the Brad Carr Podcast, and now, here's Edward, Chancellor. So, Edward, what do you think of some folks' bold claims about the future of China?
Well, I was watching your podcast with Peter Zeihan, and I thought his claim that China wouldn't exist as a nation state within 10 years was pretty bold. I mean, the country's been around for two and a half millennia as a sort of empire nation. So to say it was going to be end in 10 years, a strong claim. I write a column for Reuters Breaking Views, which is the Reuters commentary service. And this column is on what I call a sort of a bubble in apocalypse publication. So you've got this, Peter Zeihan with his amusingly titled "The End of the World is Just the Beginning." Great title. Then you've got Nouriel Roubini of NYU with his sort of more prosaically titled "Mega Threats: 10 threats that are." Mega threats that are, going to threaten your future, from the mother of all debt crises through to, are being enslaved by by robots in 10 years' time. You've got, what are the other? I mean, I suppose the Ray Dalio book on, which came out last year on the New World Order is more, the rise of China, the collapse of the Chinese empire. We'll see about that. There seems to be a lot of sort of crisis books about, and actually this book, we're going to talk about my own book on the history of interest. When I tried to get my publishers interested, because publishers often don't really get out of bed in the morning, I said to them, you don't know what this is dynamite. I said, this is the first book of the next crisis. I said the crisis can appear when interest rates rise from their extraordinary low levels. And I sort of pitched it to them, to their marketing team, sort of in January on this front, and they all yawned. And then 6 months later, the editor wrote to me and said, "You were right. This is the first book of the new crisis." Anyhow, as I point out, Peter Zeihan and Nouriel Roubini, there's quite a lot of competition out there at the moment.
Yes. And from your historical perspective, besides China's lasting just 2.5 millennia, what else do you see that might suggest a stronger future for China?
Well, look, I mean, I'm not bullish on China.
Okay.
I used to work for this investment firm, GMO, in Boston, and if you sort of do a Google search, you'll see I put out, a couple of notes. 12 years ago, early 2010. One was entitled, China's Red Flags, which was pointing out, the debt, the massive growth of debt, the housing bubble, the corruption, the dangerous flow of credit into sort of unregulated shadow banking and so forth. And I thought that the housing bubble would burst back then, but it sort of continued for much longer than I thought. And the Chinese were very good at, I don't know how much you know about China, but what they're very good at doing is sort of taking a bad debt from one player and handing it to a sort of unrelated party. So debt, you don't get the sort of cascade of debt defaults that you tend to see in the West when a crisis, particularly when a property market turns down. And they kept the real estate boom going for much longer than I believed. Having said all that, and I've got a chapter in this, in this new book called, it's called Financial Repression with Chinese Characteristics. Financial repression being the term that economists give to interest rates being kept below the level of inflation. And I sort of point out how that creates, an unbalanced economy and fragile financial system. That chapter concludes with the view that the Chinese economic miracle is over. I think that's the case. I wouldn't go so far as Zeihan as to say that China won't exist as a nation state in 10 years' time, regardless of what happens to the global trading system and so on. You can have, China, 19th century, they had the Taipei Rebellion, which went on for 30 years and killed, 25 million people, and China still existed as a nation state. So, I suppose what is it, the best way that one should make forecasts, and I think this is true of, particularly of the geopolitical strategies, is to assume that the past continues into the future. That making very bold claims I'm definitely, from an investment perspective, if you're going to make them, you have to be quite cautious. You want to sort of hedge them. And I think that's probably true of China.
And you said that as looking at things as a historian as well, that it's often good to see things continuing kind of as they are, things that have lasted a long time to continue to last. What would be the logic there?
Well, have you read, Philip Tetlock's Expert Political Judgments? Have you come across that?
No, the place where I've seen this idea is in the writings of Nassim Nicholas Taleb, who wrote Black Swan, Anti-Fragile.
Yeah, so Taleb said, the continuation of... so the Philip Tetlock, very well known, he became very well known for the book Expert Political Judgment, and the premise of his book is that actually experts make extraordinarily bad judgments politically, and leave aside the financial guys. Yeah, the experts never see. They never, they miss out on, they missed out on the collapse of the Soviet Union and so on and so forth. You can make very bold judgments, but one tends to get them wrong. My own view about, I've been sort of working in the financial world for 30 years and really for 28 years, sort of working as a sort of writer, historian, investor. And my own view is slightly different in a way that the financial analysis is a bit of an easier game in some way than political analysis. Political analysis, you get everything's normal, then you get the Russian Revolution, everything, you get the Chinese Revolution, you get, the invasion of Ukraine. Well, and some of these, you might see problems building up, but they're almost, and they're not, particularly my field, but I can see why you might be forgiven for not actually nailing them. The ones who nail them, the political scientists who get these things right, they're what Tetlock calls the hedgehogs. They just have one thing to say. It's 1917. Russians have a revolution. The hedgehog says communism is going to fail, and it's every year until you fast forward 72 years, and hey presto, communism fails. But they've been wrong. They've been wrong for 70 years. And in investment world, they say to be early is to be wrong. So you've got to be slightly more cautious in financial world. Having said that, what we have in the financial world is we have these cycles. Yeah? And that you have these credit cycles, you have these speculative cycles, you have these economic cycles, and if you have a decent sense of history or decent knowledge of history, and this is why I think knowledge is, financial history is very important for people in the investment world, is you see these patterns, these repetitive patterns, and in fact, I think that. I was watching I haven't actually read the new Ray Dalio book, the New World Order. But I did see that, he's put out a sort of 30-minute video, sort of very expensively produced with sort of, I don't know, 50 million viewers. Yeah? Probably more people than, will actually, dare I.
We can hope.
I don't know. I like a niche market, but anyway, so it's got its 50 million viewers, and actually, what Dalio says is, what he says is, what I'm doing is looking at history, looking for the cycles of history, and then trying to learn from them. And when I worked at GMO for Jeremy Grantham, that's sort of what Jeremy was doing there, looking at the great speculative bubbles and then seeing how they pass through. So and basically the people with the historical bent were able to call. We're able to call the dot-com bubble for what it was. In aftermath, in retrospect, it looked completely obvious. Of course, it was, but it's remarkable how many people, were buying into it at the time, and then the historians got, by and large, the credit crisis, which the economists themselves seem to have, almost to man, with possible exception of Nouriel Roubini, but I think he slightly over-eggs his claims. But never mind. The economists didn't see the global financial crisis coming, but if one had a knowledge of previous credit booms and so on, you saw it. As for the current period, I mentioned that I spent the last 5-6 years sort of researching the history of interest and of interest rates, and what I found is that periods of extremely low interest rates were coincided with the great speculative bubbles in history. It's a subject I'd written in an earlier book. I wrote a book, actually came out in '99, called Devil Take the Hindmost, which is a history of financial speculation. And what I hadn't, perhaps one of my mistakes in that book, which had been very well received, but one of the things I'd sort of slightly overlooked in that book was the sort of monetary contribution or the monetary background of the great speculative manias. And so in this new book, I'm trying to bring the role of interest rates into the foreground. And I look at, if you remember, I look at, for instance, the Mississippi bubble in France in 1790-20, and show how the Mississippi bubble was created by this Scotsman, John Law, who came to France and was allowed to establish a central bank, France's first central bank, who had on the side, the Mississippi Company, which was this trading sort of holding company that owned a whole load of different businesses, including half of the current United States, the Company of Louisiana. Anyhow, what Law did, and it's very instructive to recent events, is his central bank issued a paper currency, a paper money, and it doubled the money supply in a short period of time, and the money it printed was used to buy shares in the Mississippi Company, and those shares were issued to convert France's national debt or royal debt into Mississippi Company shares. So there was a sort of debt conversion into equities, but those equities are then supported by money printing. So a bit complicated, looking out from on high. But the basic gist of that is that Law was engaging in a massive quantitative easing experiment. And as I say in the book, the aim of Law's aim with quantitative easing was to bring economic prosperity, end deflation in France, boost asset prices, which he managed to do with the Mississippi Company, whose share price rose 20-fold in, 9 months or so. So it's sort of a bit like a meme stock, except the Mississippi Company's market valuation was probably twice French GDP. So it's like a mixture of a meme stock merged with a fang, or all the fangs put together. And for a while, John Law, who owned shares in the Mississippi Company, was, by his own reckoning, the richest man who ever lived. And then it all fell to pieces because, guess what? The money printing, the QE, initially inflated financial prices, but escaped into the broader economy. There it inflated commodity prices. And then France was in the middle of a high inflation, and people started selling their shares. Mississippi Company stock started to crash, and Law in the end decided to tighten monetary policy, in this case by withdrawing his notes from circulation, after which the whole thing completely crashed and Law had to flee the country. There was Law, the richest man ever, the first man, but the model, and this is most extraordinary, you remember I wrote about it, that Law, despite his failure, became the model for modern central bankers. Yeah, even though his QE turned out to be pretty disastrous. So that's a good example of how, if you read the history of the Mississippi Company and what Law was trying to do, bringing interest rates down from 8% in sort of 1715 down to 2% in 1720, and how you see that the effect of that, the 2% interest rate, was to push the Mississippi Company share price onto a price earnings ratio of 50 times, which is, as you know, a 2% earnings yield. And given that all its earnings were paid out in dividends, this was a 2% dividend yield. And Law at the time said, hey, the low interest rates justify the high price of the Mississippi stock. Well, I mean, they were saying that 2 years ago, yeah? When the Fed, I don't know if you're aware of it, but the Fed has a model for valuing equities, which is to take the earnings yield of the market and compare it to where the treasury yields are. So if you bring the treasury yield down to 2% or below, given a little, a couple of points of equity risk premium, you justify a very high valuation on the equity market, by the end of last year, US stock market was trading at the highest cyclically adjusted price earnings ratio at any time in history. We have data going back to 1870. You can find it on Robert Schiller's webpage, who runs it from Yale University. And so you've got the highest level of stock market at any time, except for the peak of the dot-com bubble in late 99, early 2000. And that was justified by the low interest rates. And even Robert Schiller, who, wrote a book, Irrational Exuberance, that was published in early 2000, roughly coincident with the peak of the dot-com bubble. But Schiller sort of lost confidence in a way in his model and started then showing a model based on the cyclically adjusted earnings yield of the market relative to the bond yield. And I don't know why he did that, because to my mind, what was going on last year was pretty much pretty great bubble. 2020, 2021. Charlie Munger, Warren Buffett's sidekicks, said it was the most extraordinary period in the financial markets ever. And I think Munger was pretty much correct. I mean, it was an extraordinary market, and if you think about it, it was against the backdrop of pandemic, which normally you would expect to be negative. You've got a really strong market, and I think it can you can only see that coming. You can only explain that by extraordinary loose monetary policy and then the fiscal policy that threw everyone a stimulus check that they then cashed in with Robin Hood markets and went off, cornering meme stocks for a while.
Edward, let's try to use your historical expertise with another an interest-related current event. There's a lot of discussion here in the States of wiping out student college debt. What would we see based on your historical perspective if something like that were tried?
I argue that there's a sort of student debt bubble, and that too many people were going into higher education, and there was leading to what Peter Turchin calls elite overproduction. Perhaps as someone who went to Oxford and Cambridge, I shouldn't really be complaining about elite overproduction. Perhaps I should. Perhaps I don't want too many competitors. Anyhow, I think that too many people were, being enticed into it. Partly, as I say, because the low cost of the debt. Also, I think a lot of people in finance, go to universities, want to get jobs in finance which pay well. And again, I mean, not for me to complain because I've spent my life working in finance. However, why do they want to go to finance? Finance pays well. Why does finance pay so well? It pays well because in decades we've been living through one successive bubble after another, and that benefits, it leads to the very low interest rates have led to what I call financial engineering, which is leveraged buybacks done by private equity or leveraged share repurchases. Then you've got bubbles, stock market booming, very good for senior CEOs, very good if you work for an investment firm. Basically, the firm's income is a derivative of the level of the market. So even if no one adds a basis point of alpha in the company, or even if they subtract 150 basis points of alpha a year, which is probably more or less the norm, they're still going to get paid well at the end of the year if the market is up, providing all the money, all the clients haven't rushed into index funds, but that's a different problem. So people elect to go to higher education, partly because the funding is cheap, the cheap debt, and then partly because they see these sort of, if you will, bubble professions that they can go into that should pay well. So I don't know. I'm back to your question: what would happen if the student debt, were paid off? Perhaps it would. I mean, I think for the people who are indebted, it would be a good thing because they perhaps, a lot of them, you can see this in the data, that a lot of people have picked up large debts at college and are unable to find jobs that really justify that debt. They earn average or below average earnings. I think for some reason the New York Fed, I never quite understand, looks at the extent to which graduates are employed in inverted commas graduate level jobs, and they find, I think, something like only 40% or thereabouts do so. So, I mean, it's not really an answer to your question, but my view is, I think of going to college nowadays, you might think again just to see whether you're really academically interested. I wouldn't really go ahead, People didn't have the academic interest.
And what does it say about interest and the title of your book, the price of time, if we can take interest rates to zero, or if we can completely wipe out debt that had interest in the first place? What does this mean? Is time going backwards? Isn't there a significance to this price of time?
Yeah, I mean, that's the thrust of my book. Is that interest is the most important aspect of finance, because it's with interest that we're able to put a price on financial assets and on real estate assets. You simply not possible to put a value on a house unless you discount its future payments, or on any asset at all. You cannot have capital without interest. You can't invest without interest, because if you're investing in, if you're trying to choose between, what type of investment to make, you need a hurdle rate or a discount rate to arrive. You've probably done it in spreadsheets. Use an internal rate of return in the spreadsheet to get to your net present value of any projected investment. So if you don't have an interest rate, you're going to have all sorts of weird investments taking place. And we've seen some pretty weird investments in the last decade, not least some of the stuff coming out in Silicon Valley. And interest is an inducement to save. So if you don't have any interest rates, there's less inducement to save, so you're going to have inadequate savings on the future. But interest is also the rate at which savings compound. So if you don't have any interest, whatever savings take place will compound more slowly in future. So you can say, goodbye to retirement. Well, that's problematic. Interest determines the amount of risk that takes place in the financial system. Interest is the price of risk. So if you get rid of risk, or if you turn it negative and reward people for taking risk, you're going to have too much risk taking part in this. Interest is the price of borrowing, which put another way is the price of leverage. So if you take down the price of borrowing to nothing or next to nothing, you will have a huge amount of leverage. And then interest is always, and this is an important part, it's always about the distribution of income, and it's also about the distribution of wealth. And although historically in a sort of in a traditional society, agrarian based, very high interest is associated with the exploitation of poor farmers, and you find it in the ancient world, and even in the modern world in some parts of the in some less developed countries today. In very high interest actually can lead to debt bondage and slavery. It was in Greece and Rome, high interest was the route to enslavement. So obviously not a good thing. However, in the modern world, interest is actually a payment that is made to somebody for use of their capital that can be done for productive purposes. And if you don't pay savers, if your rich capitalist doesn't have to pay a saver anything to take possession of their savings, their property, and makes a great deal of money from it, which is the case of private equity firms over the years, then you're going to have the result, an increase in inequality, increase in inequality distribution of income and wealth, And you're going to have a resentment against the capitalist system. And what we see, and we've seen in recent years, is that by and large young people faced with house prices that have been pushed out of their reach because interest rates are too low, faced with these large student debts but unable to get jobs that they want, seeing an economic system that, operating with very low productivity, which, as you remember in the book, I ascribe to the low interest rates that lead to the misallocation of capital that feeds through to low productivity and low income growth. Then if you understand that interest is the cardinal feature of capitalism, if you take the interest down to zero or you turn it negative, you actually start to erode the capitalist system, and you erode faith and confidence in the system itself, because the system only rewards the haves and has nothing to give the have-nots. Now, if the have-nots then find themselves in a majority, then you see they're not going to be contented with the status quo. So I would, to some extent, ascribe the rise of populism and the discontent among the younger generation with conventional capitalism, even democracy, to some extent, that has been a consequence of these extraordinarily low interest rates.
This seems a very important part of the book. What happens to a capitalist system in the long run if there is not a market-determined interest rate?
Well, good point. I argue that that every society or economy requires an interest rate in order to help allocate capital efficiently. I mean, think of it this way: we all understand that the price of normal goods and services, the reason they have a price is to help allocate them, to help you make decisions. Do I want a can of beer or a bottle of wine? Well, it's slightly depending on the price and your own preferences, but the price determines the allocation of capital, of spending. Now, interest determines the allocation of capital. The Soviet Union failed, among other reasons, for the fact that they didn't have an interest rate to help allocate capital. The allocation of capital was done badly. I think without an interest rate, market rate, to determine the allocation of capital, any system, including a capitalist system, or perhaps in particular a capitalist system, is likely to start to fail. And I think that's what we've seen in recent years.
So start to fail. Would you say that capitalism in the West, in the United States, is on a path to failure?
Well, I'm saying it would have been, it was last year. And you remember, as I say, that as the system ceases to fail, there are more calls for the government to step in to aid with investment. The central banks start taking a bigger role in not just conventional policy of trying to control inflation, but they also start engaging in credit policies, and you saw recently moving into the area of environmental policy, which would any central banker prior to the last 10 years would have been pretty shocked that you're going into this area that's way beyond the normal remit of a central banker. I mean, it's a political remit, it's not a central banker's remit. So I think we have been moving in the direction of the state taking a larger and larger role in economic life, and the central banks moving way beyond their normal remits. The lockdowns that accompanied the pandemic, they were accompanied by, as you know, extraordinarily large fiscal deficits. And those fiscal deficits were largely financed by central banks issuing money, was in effect buying the debt that was being issued, not directly but indirectly. So, $1 trillion of treasury bills issued one day, the next day, the Fed's in the market to sort of buy a corresponding amount. It's not, they're not directly borrowing from the central bank, but indirectly. I don't think any of that, to me, you wouldn't have had the lockdowns had interest rates been at normal levels, because the cost of funding them would have been too high. Everyone would have said, in Britain, where I am, I think the cost of lockdowns was, and throwing the whole COVID policy, roughly 400 billion pounds, and the government, the Bank of England owned around 850 billion pounds of UK government debt, which was costing the government at the time 10 basis points. So you can see that if you can borrow ad infinitum at 10 basis points or less, if the government can borrow at that level, well, it's going to start, crowding out all the other actors. And in that sense, normally, inflation that then ensued, we say, yes, cost of living crisis and higher interest rates, which mean now, stock markets coming down, bond markets coming down, and then, the property markets teetering, because, as you know, the cost of, the 30-year mortgage rate in the US has doubled over the course of the year. So inflation at some level, and the rising interest rates are a bad thing. But actually, a more positive spin would say, hang on, it's at least getting us out of this low interest rate trap that was also leading to a growing, an ever increasing role of the state and the central banks in economic and financial life. So that's a silver lining, so to speak.
And to look at these two poles of very high interest and very low interest, so it seems at a very high interest rate we run a risk of debt slavery, and at the very low interest rates we run the risk of people being crowded out, whether by private equity institutions or governments, whomever can borrow cheapest. So the golden middle, how do we find that? What makes that appropriate interest rate?
Yeah, it's a good question. The trouble is, there is this concept which I discussed called the natural rate of interest. And the natural rate of interest is, if you will, the ideal rate of interest, perfect equilibrium rate in which, you live in the best of all possible worlds. Trouble with our natural rate of interest is it's sort of an idea. It's an ideal. We can't observe it. The central bankers and the monetary policy, the monetary economists, draw on this Swedish economist from the late 19th century called Knut Wicksell. And Wicksel's argument was the natural rate of interest was rate of interest in which consumer prices were stable. Hence, all this, hence the central banks targeting a 2% interest rate and saying we're going to keep, 2% inflation rate, and we're going to move interest rates to whatever level to keep the stable inflation, because that's where the natural rate must be. And one of the arguments in my book is that the price level in the short term, or the rate of inflation in the short term, doesn't really tell you where the natural rate of interest is. And in fact, if you target price stability or 2% inflation rate, as they've done recently, or price stability as they did in the 1920s, if you just have that target, and you keep and you've got, and that target turns out to be wrong, as I believe was the case in the 20s and more recently, then you're going to fuel these asset price bubbles and credit booms that then follow by bus. So if you remember, I say somewhere in the book, it's difficult to know where the interest rate, the natural rate is, but you can tell it by its absence. You can tell it if there's a real estate boom going on, you probably haven't got the right natural rate of interest. If there's a stock market bubble going on, you probably haven't. If there's a credit boom going on, you probably haven't got it. If there's widening inequality, driven by movement in asset prices, a burgeoning, if you've got a bloated financial system, you probably haven't got it. So you can tell it by its absence rather than identify it directly. I mean, some people, I have a friend who's a good financial historian and economist called Felix Martin, and Felix argues that it's time to dispense with the natural rate of interest theory. Keynes argued against the natural rate, but then I think Keynes argued against it because Keynes didn't really like interest at all anyhow, so he was sort of bound to argue against it. My own view, I take as a sort of proxy for the natural rate of interest, the trend growth rate of an economy. And in the 1920s, US economy was growing 8% a year, and although interest rates were high, sort of New York Fed reserve rate was, sort of in the range of 4%. So it would seem quite high by our level, what we've been used to recently, but it was very low relative to the very strong growth of the US economy. So if the productivity or aggregate return of capital in an economy is high for some reason, as it was in the US in the 1920s because of technological boom, or in China because of modernization in recent decades, probably my best guess is you can infer the natural rate of interest by the trend growth rate. Mm-hmm. And in the US and in US in 20s, US in recent decades, and China also, rates, I think probably you can see have been with a broad picture being kept well below their natural equilibrium rate.
As there is frustration with interest rates, inflation, these sort of things, I'm hearing more discussion of people who want to exit the system and start off on Bitcoin. What does history tell us about the potential of Bitcoin?
Not sure if history tells us anything. There've been any number of types of money. I've got a book somewhere in my shelf on primitive money, which includes, everyone knows about cowrie shells, but I think in one country, rat traps were currency. And then you've had a lot of private monies. In the late Middle Ages, the European merchants had their own currency called an écu de marque. So anything can really be money, and historically, and it's not anomalous for groups of people to create their own money. We have monopoly money after all. However, the problem with monopoly money, and probably the problem with the cryptos, is that they don't really serve a function outside of the game. And what I argue in the book, in my chapter on the bubbles propagated by the very low interest rates, is that you had a lot of virtual wealth. That was what people thought was wealth, but was just an illusion of wealth. So let's say, you were sitting on, a couple of $100,000 worth, in inverted commas, of cryptocurrencies. Shiba Inu coins. Well, is that wealth? What is it? it's nothing. It's an illusion. Yeah? It's it's the Matrix. There is no spoon there. The steak tastes good, but I know it's fake. Yeah, and actually, I mean, there's a lot of self. I mean, you have to give, the guys, on Wall Street Bets. I don't know if you ever went to the Wall Street Bets website, but and they styled themselves, autists and retards and degens, and they arranged all these, these mean stock corners. But they were saying, the game is fixed. That we're living in the Matrix. So they were just playing a game, and the crypto was a sort of game. I mean, I'm perhaps some people, believed the crypto story, but and I read a book. Can't quite remember what it's called, by someone called Balaji. Have you heard of this man called Balaji Srivenisan or something like that?
Yes.
Does that mean anything?
Yes, he's been coming up a lot lately, and his book, The Network State.
Yes, it's interesting. I mean, actually, the historical stuff is quite interesting. It'd be worth getting him on your show. But I mean, on the one hand, it's pure fantasy. It's sort of transhumanism, or what do they call it, singularity or whatever, where we just sort of slough off our skins and just sort of download ourselves into a matrix, yeah. And then in that matrix we can have our little our cryptos to play with. Well, I mean, perhaps that's going to happen. The other aspect of it is that you're going to live in a world of central bank digital currencies where you've got surveillance capitalism and social credits and so on, and you're going to need something to escape from it. And that's sort of Balaji's. It's not inconceivable, but I don't think we should make it. It's not base case, yeah. And my own view was, you could either have some digits stored on a crooked exchange like FTX, or it's cold stored in your on your laptop or in your mobile phone, where you're liable to lose it or lose the encryption keys or whatever, and there's no use to you in a sort of when the lights go out. Or you could go for some sort of, if you really wanted a store of wealth in the worst case scenario, apocalyptic scenario, then I think good old fashioned gold would do the trick, better than cryptos. But that may be a sign of my age, but I've never felt that the cryptocurrencies met the I never felt that they performed any of the traditional functions of money, store of value, use in exchange, something that which you could pay a debt with, legal tender, which they're not, obviously. And so I felt that they are, go back to the theme of the Matrix, that they are what the French philosopher Jean Baudrillard called a simulacrum of something that resembled another object, but had none of its innate characteristics. So you might say that was, a will of the wisp, a fantasy. And then, and I argue in the book that these fantasies tend to be sort of fed by the low interest rate policy, because if you don't put a price on money, then of course everything else is going to be mispriced. So you do have this Alice in Wonderland world, and we have been living through a sort of financial wonderland, which is, very, people like me who are financial historians and commentators. It's obviously very interesting for us, but it can come to no good. So you're engaged in the daytime, And when when you go to bed at night, you think, what the hell is going to come? I mean, perhaps actually the end is what Balaji envisages, in which case, crypto does have a future. I don't know. You
Yeah,
better
it seems
ask.
it seems it's the matrix on one side, but then the central bank digital currency and all of that is a sort of dystopia of its own on the other side, and we're trying to navigate to something better.
Yeah, and I mean, what can I say? I mean, I think that I do end the book, if you remember, saying, asking central bankers, a bunch of people with PhDs from universities who, many of whom, never really actually had a job in the real world and don't really know what the world looks like because they've never actually been outside academia, asking them to set this most important price, the what Jim Grant calls the universal price, is too high a task. Particularly if, as I argue, the level of inflation is not going to really tell you as much as you need to know. So we probably do need at one stage in the future, to get back to a world in which interest rates really are set by markets rather than by central bankers. And, it's conceivable that if you had a well-designed central bank digital currency, and that may be, an oxymoron, because it may be that they will never design one because for a lot of people, a well-designed digital currency has to have some type of anonymity in transactions. And the authorities are always going to say, hang on a second, this will just be used by terrorists and drug dealers and that sort of thing. And so they won't like it. However, say they did accept that. Say you had a CBDC that just increased by an increment, a small increment every year. It's sort of roughly in line with GDP growth, say 2% a year. So in that sense, it would sort of resemble the gold standard, but it wouldn't have the inconvenience of sending someone down a deep mine at the other end of the earth, and in order to dig the gold out of the ground, then stick it, after all the refining and everything, stick it in another hole in a bank vault in the city. You could have a digital currency that was limited, and that would then mean that the cost of interest would be actually determined by someone lending a finite amount of money, because there was only so much of it, and they would have to lend that, so to speak, out of their savings, and then the interest would be how much people were prepared to, the price set by borrowers and lenders, and that would be, close to market rate. So it's conceivable. Look, this year, or was it last year? It's the 50th anniversary of the breakdown of Bretton Woods. So we've had 50 years of a pure, inverted commas, fiat currency. During that period, we've had successive inflations, and we've had some, quite spectacular market, asset price bubbles, and pretty heavy financial crisis, and we may have another pretty heavy financial crisis coming up. If so, then it's conceivable, because monetary regimes tend to only last for 50, 60 years. We don't, at least that's been the case since for the past 150 years. Gold standard didn't last that long. The classical gold standard, the interwar gold exchange standard only lasted about 15 years, 20 years, and then Bretton Woods lasted 20 years, 21 years, and so we've this 50 years, it's longer than John Law's 15-month experiment. It's still not that long. And I think it ended us it ended us up with negative interest rates and all host of problems and far too much debt in the world. Global debt's 350% of GDP. That debt is not going to be paid off. It's going to be inflated away, mostly. And so it's conceivable that after the wreckage of the next crisis, we do get a reformed monetary system in which money, as I say, isn't a fiat money controlled by whose price is determined by central bankers. So I'm not holding my breath, because it's very easy to see solutions or to think of problems in the financial world, but the vested interests around the current state of affairs, the status quo, are so enormous that I don't think I personally don't spend a huge amount of time sort of campaigning for change, because it's one would get pretty frustrated.
Well, Edward, before I ask my last question, for folks who want to learn more about your perspective on this, where should they look for you online?
Well, I have a website, edwardchancellor.com, and I post sort of the articles I write are posted there. I sort of put up podcasts and videos, whatever, and you can even contact me if you want. So yeah, that's probably the best way to get me.
Great. We'll put links to all of that in the description for folks to check out. And Edward, my last question is, with this discussion of changes in money, what are the historical trends regarding how that projects out to great power conflict?
It's difficult to say. I mean, I was watching the Dalio video where he's talking about, I think he's talking about the currency establishing the great power, where I think it's probably the other way around. If you have a powerful economy and an army, then you're likely to establish financial primacy, like the British did in the 18th and 19th century, and the Americans have done since then. With regards to China, we said earlier that China, I think the China miracle is over. And as Peter Zeihan told you, population is declining too, so that's a problem. So I think China has grown old before it becomes rich. I think that, but more problematically, unlike Britain, so if you think about the great financial powers of the last 300 years, Dutch Republic, Britain and Holland, they all had protection of property under law, and China doesn't have that. China also has capital controls, where you can't have capital controls and establish financial primacy. So although the Americans abuse their, so to speak, exorbitant privilege, as it's called, and although Americans have run up, net financial assets, foreign assets, the Americans are sort of negative 40 or 50% of GDP, in that range. Normally the financial hegemon is meant to be lending to the world, not sort of bleeding it dry. Yet I don't personally see the yuan, Chinese yuan, replacing the dollar. It's conceivable that you get as a division in the global system in which you have a yuan bloc, countries indebted to China through the Belt and Road Initiative and so on, and who are obliged to sort of, take yuan and bill in yuan, so on, and then you get a dollar bloc. But I don't think you're going to get a dollar replacement on a global basis from China or anyone else, really. Mm-hmm. Because Philip Tetlock would say, the experts always get it wrong. So don't ask them.
Well, Edward Chancellor, thank you for having the humility to say that while also writing a great book and communicating these ideas here with me today. I really appreciate it.
Thanks. Good speaking to you. You're a good interviewer, Brad.
Oh, thank you so much. Thanks for watching this episode. To help get more great guests on the show, be sure to subscribe.